We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today again is returning guest Michael Gayed, portfolio manager and publisher of the Lead Lag Report. Thanks for joining me today, Michael.
Always a pleasure, Tom. I appreciate it.
So I'd like to start by talking about some interesting intermarket signals that are flashing here. You look at market signals and relationships that really lead each other. So can you give us some examples of what these relationships are that you look at?
So those who are maybe repeat visitors will probably joke that I always start off by saying, these 5 different award-winning research papers I put out since 2014 show that there are these leading indicators to conditions that favor higher or lower stock market volatility. The 3 primary relationships that I've uncovered in these different, award-winning white papers are the behavior of utilities against the stock market, the behavior of long-duration treasuries against intermediate, and the behavior of lumber to gold, with lumber to gold being the one that's getting the most attention in the media because of my focus on it on my Twitter account at Lead Lag Report. And the joke about the research I've put out there as far as these leading indicators is that I basically wrote the same concept 5 different ways, which is to say that everything I do is ultimately about sensitivity to the demand for money falling. Okay, it's all interest rate related, right? Utilities are the most bond-like sector of the stock market. Treasuries are interest rates, and lumber relative to gold is about housing, which is ultimately about mortgage rates. So everything's ultimately about changes in the cost of capital and what that implies in terms of liquidity, and as such, volatility, major crashes, corrections, and bear markets. Now, this year has been really quite remarkable in a lot of ways. As we talked about before, it's a little odd that Treasury yields have been going down and grinding lower since mid-March. Let's call that risk-off signal number 1. Mm-hmm. It's a little odd that you've had lumber to gold, which went vertical, completely crash and looking like it wants to continue to do so. Also another risk-off signal. Even more odd relative to that is that utilities have underperformed, actually signaling risk on, even though historically utilities tend to confirm the message of treasuries, meaning usually when treasuries are strong, utilities are also strong, they confirm each other. There's been this massive disconnect between the message of utilities against the stock market and the message of treasuries. That may start to resync, which I'm sure we can get into. But keep in mind, all this is happening, yields dropping, lumber to gold crashing, Bitcoin also crashing. All that has happened in the context of trillions of dollars of stimulus. And then you start looking at other parts of the marketplace here. So you have this reopening trade, you have this inflation, reflation hope. If you look at the Russell 2000, you look at small caps since February, they've gone nowhere for 5.5 months with a lot of volatility every single Monday through Friday, but zero traction. Again, despite all these trillions of dollars stimulus, that seems a little risk-offish to me. Emerging markets have gone nowhere since early February. That seems a little risk-offish to me. And then I thought all these trillions of dollars was going to translate into a lower dollar. Well, when you look at the dollar index, it's actually positive as we speak for the year. So I look at all this, and meanwhile, the S&P is just grinding towards all-time highs. And then the question that I ask myself is, okay, what if all these other areas which are most sensitive to the reflation narrative, which is what the S&P is holding on to, what if all those areas are right? What if the Fed is right about this inflation being transitory in the context of these trillions of dollars of stimulus? Mm-hmm. Wouldn't that then suggest that you could have a big downside surprise as the S&P suddenly realizes what everything else is screaming? So like I said, starting off the conversation, everything I do is rules-based, is based on these quantitative indicators. It's not, I'm just trying to give voice to the math. Mm-hmm. The math looks very weird here. And I think it looks very concerning in a lot of ways.
Absolutely. It seems like all of these, let's say, previous correlations are really just in la la land here in the past year. Like all these tight correlations that have traditionally signaled one thing or another a lot of these relationships have broken. So the last time you and I spoke, as you mentioned, we were talking about the warning that the lumber to gold ratio was going to basically revert to the mean, and you were right about that call. So maybe let's talk about some of the, let's say, the downstream effects of that indicator that have followed, and why it's a much larger, let's say, problem than something that would just affect the housing market.
Yeah, no, so this is a good kind of discussion point. So first of all, I agree that this is what's happening in lumber is probably mean reversion, right? You have this disruption because of COVID. The sawmills were shut down, then they come back on. Then again, lumber should have never gone vertical the way it did, because it's not like in 6 weeks, housing suddenly had a huge surge in construction demand. So lumber rose substantially, completely outside of its historical range of 200 to 400 on the front month contract, and then totally crashed. Now, the thing with mean reversion is that mean reversion means you have to go past the mean, which I don't think people really actually think about. Mm-hmm. Because if you stop at the level that it's at now, you're still not only above the mean, but even if it were the average for the last 30, 40 years, you have to go past it to undo all the excessiveness to begin with. So I actually think lumber can keep on breaking down. Now, keep in mind, housing data is starting to slow down. You're seeing that with some of the starts and some of these expectations. So the lumber crash, yes, it's a function of now supply coming back in, but also it's a function of demand also slowing down. And that should make sense. Anybody that's listening and watching this, I'd be surprised if you didn't say you had a story about somebody you knew who was trying to bid, over ask and multiple times over ask on housing property. I mean, there's been an incredible surge in housing, as we all know, and we're at a point now where median income to housing prices looks a little bit like 05, 06, which is the last time housing peaked. Okay, now other implications on lumber. So why is lumber relative to gold important? And this relates to that paper that I won an award on in 2015. And you can see this in my pinned tweet on my Twitter account at Lead Lag Report. Prior to every single major crash, correction, bear market, lumber to gold tends to be weak in advance because, again, it tells you about housing, because the average home has about 16,000 board feet of lumber. Same dynamic, by the way, with utilities and treasuries. Right? Again, going back to these are about interest rates, demand for money changing. Most major crashes, corrections, bear markets are liquidity driven. So interest rates would reflect that. These areas, as tells to that, would react earlier than most other parts. Now, lumber to gold has crashed. A lot of people think I'm making a call that the stock market crashes. I'm actually not. What I'm suggesting is that it's raining. The conditions are there for the accident. Mm-hmm. Just because lumber to gold has crashed doesn't mean stocks have to guaranteed go down. But historically, when stocks do go down and volatility rises, lumber to gold tends to already be weak. Mm-hmm.
It's now correlation versus causation.
Right. So it's causation in terms of the why, if it's a true signal. Right. Whereas, the correlation you could say is low because the false signals can be quite high. Now, keep in mind, we have not yet had a risk off period. So all these signals, everything I just started the conversation with you on, they're all saying risk off. Okay. But you haven't had volatility rise. So maybe they're false signals, or maybe the market's going to act with a lag and respond to it. But it's been okay if you've been playing defense for the most part, even though you haven't had the stock market go down. Meaning if your expression of risk off is treasuries, like it is with my RORO risk on, risk off ETF, using lumber to gold as a trigger. Well, guess what? I mean, treasuries made money, even though stocks haven't gone down. So it's important to know with all this stuff that every strategy has three components, right? One is the signal, lumber to gold, utilities, treasuries, moving averages. Two is the look back period, 200-day moving average, 50-day moving average, what time frame you're evaluating your signal under. But just as important is your opportunity set. Ideally, you want an opportunity set that allows you to be wrong and make money. Treasuries are among that. If you do have a readjustment to this message that other parts of the marketplace are saying, which is actually screaming disinflation, deflation, the stock market can have a very violent downside surprise. But if it doesn't happen, you've made money waiting. You've made money still slowing down, entering the storm, being in treasuries throughout that.
As you mentioned right there, Michael, there's some indicators that are screaming disinflation, deflation. Tell us more about that. Let's say what signals are showing us that? And we see everybody talking about inflation, and to be, let's say, contrarian about it, because everybody's focused on inflation, is that likely that we're going to see the exact opposite?
It's very interesting because everyone always talks about inflation, and actually, I do agree that there's inflation. It's just not the right kind of inflation. I mean, it's not wage inflation, right? So really, I think when we talk about inflation and being right or wrong, the what matters most is incomes, not the cost of goods, right? Now, I put this tweet out a few days ago. I made this point that we all better hope that Powell is wrong, that inflation is transitory, because if inflation is transitory despite such a huge surge in money supply coming out of COVID, that seems to me like that's the Fed admitting that everything that they're doing can't actually create the long-lasting inflation they want. It's actually the Fed saying the system really is broken, the debt is too high, and that we are pushing on a string. There's actually other implications to the notion about whether inflation is long-lasting or not. So in many ways, I kind of hope it is, so that the Fed can clearly show that it still has power over this, right? Now, as far as the individual relationship, so again, in the context of all these trillions of dollars, again, yields have been dropping. Now, I will admit, even within the bond market, there's this disconnect, right? So absolute yields have been dropping. Negative real rates have gotten more negative. Absolute yield dropping would suggest disinflation, deflation. Yield curve flattening suggests disinflation, deflation. All that's happening. But even internally in the bond market, you still have a strange disconnect, which is that tips are outperforming nominal treasuries. I mean, if you look at Treasury inflation protected securities, even though absolute yields are signaling disinflation, deflation, there's still a lot of internal buying of CPI adjusted type of bonds, funds, right, and bonds in general. I think that's actually going to come back in. I mean, I think tips are probably wrong, and I think probably nominal treasuries are probably right. The other part of this is the dollar, right? So usually when the dollar is weak, it's a form of importing inflation. It means that inflationary pressures are rising. Well, last I checked, the dollar is positive for the year. Again, despite trillions of dollars of stimulus, right? And no central bank is as good as printing dollars like the U.S. Federal Reserve is. So the dollar actually improving is interesting because it actually suggests there's more disinflation, deflationary pressure coming into the system. The final part of this, which is also at odds with this reflation narrative, is very recently, at least, it looks like credit spreads in the bond market are starting to widen. Okay? In other words, if you look at junk debt yields relative to treasuries, they just started a little bit this week, but I think it's going to continue. Those are just starting to widen and blow out. Now, one that makes some sense. So usually when spreads are narrow, the dollar is weak because high yield corporate credit junk debt ends up having higher yield when there's default risk, or at least the perception that companies can go bankrupt. One way to lower default risk, bankruptcy risk, is to have inflation so that the debt that these companies have is less with the amount of dollars that they're getting. But if spreads start widening, that would actually suggest that even in the bond market, there's a feeling default risks are going to start increasing, which is what you see with disinflation, deflation. Right. So it's funny because whenever I talk about risk on, risk off, it's just everything's in the framework of inflation, deflation. All these signals are ultimately about inflation, deflation, utilities, treasuries, lumber, gold, behavior of small caps, behavior of dollar, emerging markets, all this stuff. And I think we're at a point now in the system where that's kind of the only question that does matter. So it is the right question to ask. The fact that everyone has been so bulled up on this reflation narrative, despite all these other parts of the marketplace spitting in the face of it, I think should give everybody pause about whether the narrative is wrong and the crowd is about to be surprised on the downside.
Yeah, that's a great point, Michael. And as you've said before, you can kind of see that we're in the eye of the storm currently, right? And the last time we spoke, as we're talking about debt here, we were talking about banks starting to increase lending. So has this happened, and how has the reverse repo program affected this in any meaningful way?
So the reverse repo thing is, not to get too wonky, but it's an interesting dynamic, right? Because you see these headlines about the Federal Reserve doing these reverse repos. And it's interesting because, again, I put this out on Twitter too, with the sheer amount of liquidity in the system, it doesn't seem like there's enough collateral to back it up. Okay, so the way mechanically that works is banks, lend short-term cash, right, to corporations and different entities. But in order to lend that short-term cash, all that liquidity they have on the books, they have to have collateral to back it. They have to have some kind of asset. That asset is T-bills. Okay. Well, what happens if there's a shortage of T-bills? Well, now those T-bills go close to zero, if not have negative yield. So what does the Federal Reserve do? they have to liquefy by providing T-bills and soaking up some of the excess liquidity, right? These numbers are so huge that the Federal Reserve doesn't even know, how to deal with it.
Mm-hmm.
Like, you can't get a big enough mop with this stuff, right? So, and all this is sort of just a reminder that there are these unintended consequences to all this money that's out there. You can't just have tremendous money but not enough collateral to back up your lending, right? When you're mandated to have that collateral to back up that liquidity. So a lot of distortions, I think, are happening there, and it seems like that's not really sort of abating. Maybe very recently it has, but it's a reminder that the system is quite fragile. It's not as simple as just saying, there's all this money on the sidelines and the Fed's always there. That assumes that the Fed is omnipotent. That assumes that the Fed knows itself what the secondary and tertiary effects of all the unintended consequences are of their unprecedented actions. They don't know either. And I think that's important.
Mm-hmm. I think a really good example of that would be, let's say, the amount of entry-level jobs that are still vacant, considering that everybody's being paid to really stay at home or can make more money staying at home, right?
Yeah, no, and it goes back to unintended consequences, right? Because I've always made this point that the Federal Reserve, I think, is the most powerful tool the Federal Reserve has isn't interest rates. Mm-hmm. It's urgency. Okay, you've got to create a sense of urgency by the marketplace. The reason why I think it's hard to have long-term secular inflation outside of something like universal basic income, because I do think actually that you can argue can create lasting inflation, because that's a form of getting the wage inflation, even if it's artificial. All right. The one thing the Fed has been very poor at is trying to set the stage for psychology, meaning if the Federal Reserve said, listen, we're going to follow this rules-based approach to interest rates, or they say something like, listen, we're going to raise interest rates every single month by 1 basis point, something small, right? Every single month. If you created this urgency that every single month the cost of interest is going to rise, you better believe people are going to start borrowing aggressively. The velocity of money picks up. That's how you get lasting inflation. But the more the Federal Reserve does this nonsense with these dot plots, which have zero meaning, I mean, it's just a way for people to anchor onto fantasy forecasts. The more it does that, the more it creates a lack of urgency to take advantage of these low rates. So it's like, why do you have to worry about rates rising if the Fed is telling you they're not going to raise rates until 2024? Oh, and by the way, between now and 2023, 2024, you're probably going to have another black swan, another reason for them to do more QE. Mm-hmm. They're never going to raise rates like this or in any sustained way, right? So again, I go back to the inflation narrative. I think is very, very nuanced. It's not as simple as there's all this cash out there and, don't fight the Fed. Well, again, don't fight the Fed? It's like the Fed had to do, how many rounds of stimulus did the Fed do in the midst of COVID? Mm-hmm. And the world was still crashing. It just got to an oversold level. That's it.
Mm-hmm. So I want to go back to the lumber to gold ratio here. Of course, the gold is the other half of that equation. And we've really seen it range bound here for the last couple months around that $1,800 level. So how do you see the risks for gold, let's say, breaking this range to either side right now?
So, gold tends to have zero correlation to most things, but gold does do well when negative rates are very negative, right? And when inflation historically is above 5%, there's evidence to suggest that, gold is quite strong. You're kind of at that level, at least in the here and now. Yet gold has not yet fully responded. The key word there is yet. Mm-hmm. Right. I think there is going to be, just like there might be a sudden readjustment down by the S&P to the message of everything else. I think there could very easily be a sudden readjustment up in gold relative to everything else. If anything, because if I'm right that we're in the eye of the storm and that this risk off is coming, which again doesn't mean markets have to go down, it just means that volatility is likely to rise. Well, when volatility is rising, you want more diversifiers, and there are very few true diversifiers. Right? Gold, just like Treasuries, just like the dollar, is in a sort of a league of its own as a diversifier, just given the historical correlation against everything else. So I think there's going to be marginal residual demand in gold, which should, I think, maybe pull the price higher. If you're in an environment where it's only about beta, gold, like every other risk-off asset, is just not going to work. It's not going to be that interesting. Mm-hmm. But again, I go back to the conditions are there, which suggest that if you're going to try and do an allocation there, now is probably the time as a portion of a total asset allocation.
So The last time we spoke again, you were saying that the cryptocurrency space could see a real correction. And of course, we have seen that play out over the last couple of months. And you said that these leveraged assets in general will start to see a correction or a risk off move. So what other asset classes does this apply to?
Yeah, so this is what's always because some people think I'm anti Bitcoin, which is just not true. I've said many times Bitcoin and cryptocurrencies make sense as a portion of a portfolio. I just don't know why it has to be a discussion around all or none, 100% in, 100% out. I mean, it's very simple from that standpoint. And I think the problem with cryptocurrencies, which we've seen, is that there's a segment of the investor base which I would argue is overconfident, just like it's happening maybe in some of these Reddit trades. There's a lot of overconfidence out there. Overconfidence naturally lends itself to leverage. Leverage naturally lends itself to black swan extreme declines. So it's like I don't need to know about the technology or the underlying investment. I need to know about human behavior and the link to leverage. In the case of cryptocurrencies, again, if you were to Google 50x Bitcoin, 100x Bitcoin, or Dogecoin, you may not get in the US. You can get in China. You can get in other countries. So there's this dynamic, which I think people underestimate as far as how much leverage is in the cryptocurrency space. But to your point, it's not just cryptocurrencies. There's overconfidence in stocks in general. The leverage is not as high, but the dynamics are the same. There's also tremendous leverage in high yield. Why? Because if you can borrow at 0% and yields are so low, well, then you're going to borrow at 0 to get a high yield corporate bond at 3.5%, 4%, and just throw money at these junk issuances, right? Again, any kind of unwind, any kind of liquidity scare means leverage is the first thing to go. Leverage being the first thing to go results in cryptocurrencies getting smashed like they already have, probably results in equities going down hard, probably results in credit spreads widening. It's all the same story. It's all based on overconfidence and leverage. Now, real quick on the credit spread point. So because I keep going back to this is actually quite important. And I have a little bit of an incentive here as we talk about junk debt because I launched a fund, JOJO, junk on, junk off, which uses utilities against the market to go risk on high yield junk debt or risk off in treasuries, plays credit rotation. That fund, as we speak, until public information on the website, is risk off. It's in treasuries. And spreads only look like now they're starting to widen. Right. So, again, I'm not just somebody that's kind of saying this stuff hypothetically. I'm applying these concepts. I'm applying these ideas. I'm taking active risks using rules-based approaches. Mm-hmm. But it makes sense to me that there is an air pocket that's out there and everybody's going to be surprised by it.
So, Michael, when we talk about these, let's say the amount of leverage inherent in the system, what is that correlation when that amount of leverage gets to, let's say, peak levels, and then a fall in that is precipitated by a crash? Are we at very high levels of leverage that we've never before seen?
Yeah, well, and not only are we on an absolute level, but I think the bigger issue, the trajectory is only accelerating, right? In terms of debt load, not just U.S. but globally, and you can see that internally in terms of the structure of the markets. When you look at margin leverage in equities, they tend to correlate with all-time highs. Meaning, the more all-time highs you have, the more margin leverage and more overconfidence there is, because people love all-time highs and they have recency bias, so they extend that out in time, so they take on more debt. The real effect of all of this leverage and debt is to me very simple, and it's a very Nassim Taleb black swan anti-fragile way of thinking about it. Leverage is the necessary precursor to tails wagging, meaning tails, the black swans. The tails tend to occur when the conditions are there and the conditions are there are usually around high leverage. And the more leverage you have in the system, the more these tails reassert themselves, the more these 1 in 1,000-year events end up happening more frequently than once in 1,000 years. It seems to be happening every couple of years now, where you have some of these extremes that are completely against the normal distribution idea of markets. So the more debt you have, the more volatility, the more these fat tails get larger. And it's kind of a strange dynamic, because what's the Federal Reserve's response to every single time you have a tail event, an extreme decline? Well, let's encourage more debt. Let's re-leverage, which makes the fragility even more for the next one. Mm-hmm. And then they do the same thing, and then it becomes more for the next one. So you end up having this dynamic where the fragility of the markets is only rising with every single round of trying to solve it, the fragility, right? And now, again, selfishly, I want to see that, right? Because I live in the risk on, risk off world with my RORO ETF, my JOJO ETF. But again, history shows that when leverage is high, black swans tend to rear their ugly head, and leverage is only going higher and higher. For an investor, all that means is you got to manage your expectations, because there are going to be more of these big declines, and it's not going to be because of COVID. It'll be because of something else, and nobody sees coming.
Mm-hmm. Absolutely. So when we talk about diversification, Michael, how do you think about that term, and how do you position yourself accordingly?
I always do this question to people, because sometimes you have. I was at a conference a few weeks back, and somebody approached myself and Michael Venuto, who's the co-PM with me on the funds at Toroso, said, I have these 4 stocks. Am I diversified? Because he's kind of using the old Jim Cramer, am I diversified idea. And his response, Mike Venuto's response, which is actually correct, is like, no, you're not diversified, not because of the 4 stocks, but because you don't have any treasuries, you don't have any gold, you don't have any dollar exposure, you don't have the things which are the areas nobody wants to touch. It's a very simple way of determining if you're diversified. The question every single person listening to this should ask themselves is there a part of my investment portfolio that I hate? Okay. If your answer to that in looking at your portfolio is no, you're not diversified. No, because think about it, right? Because what's the implication there? It means everything in your portfolio is working. Mm-hmm. Everything in your portfolio is making money at the same time, which actually means concentration risk. Diversification means you have to have something which is down when everything else is up. Has to be, because it's moving off of different risk factors then, right? So I would venture to you that the vast majority of people have no idea how much concentration risk they are taking. And it's working, don't get me wrong, okay? But it's working for now. Real diversification means you have to have parts of a portfolio that just aren't happening for the moment. Right? And again, gold, you can argue, is part of that. You can even argue Bitcoin is part of that, right? But that's the proper way to think about diversification.
And so when we're talking about that, and we're having, let's say, different parts of our portfolio that aren't working, do you see it as a rotation out of what you have working, and you're keeping an eye on the stuff that, let's say, you're not positioned in, but you're watching it? Or do you think about it as always having, let's say, some investment in those allocations that aren't working, just so that you can catch, in a way, catch that falling knife?
No, and so I think it's exactly the latter, right? So in other words, and you've seen these studies too. There's a lot of research that shows that the rebalancing effect is very powerful, mm-hmm. right? Meaning that you've got a target allocation, right, against a bunch of different investments, and then you rebalance it on some systematic way, monthly, quarterly, back to target. So that which is outperformed is now a larger portion of portfolio. You're selling it, and you're buying that which is underperformed, and upping that back up to the target allocation. And all kinds of research shows that adds real alpha, real outperformance, right? You can even apply that to Bitcoin. The most powerful strategy with Bitcoin isn't letting it run. The most powerful strategy, when you back test it factually, is you actually you have a target allocation, and you keep going back to the target every single month or quarter, which means you're buying low and selling high. Mm-hmm. That's what rebalancing does. So that's why I always advocate it makes sense to have as much exposure to as many different types of investments. The hard part is figuring out the percentages. We agree on that. But once you have those percentages, if you're systematic in your approach to rebalancing, you'll end up being better off than just leaving it alone.
Mm-hmm. You really need to basically have those rules in place so that you're constantly, as you said, reallocating. And I've made the analogy before that we need many buckets to catch all this liquidity that's raining down. And they're not all going to fill up at the same rate, but with different asset classes, we're going to be able to, as you said, capture some of this. So can you give us a couple simple rules to think about how to set up some of those, let's say, reallocation strategies?
Yeah, I mean, it's really a function of sort of how active you want to be. I mean, I think at a minimum, quarterly rebalancing, works, because at least you give yourself some time for something to move on a relative basis against everything else in the portfolio. Monthly also works. If, in my case, I'm doing it to the most extreme. I'm doing you can argue a rebalance every single potential week where it's all in, all out in my risk on, risk off ETF or junk on, junk off ETF. But it's really more a function of sort of your own comfort level. The key thing, I always make this point, is like the key thing to any rules-based approach is that you stick to the rules. Mm-hmm. You've got to create the rules in a way that's consistent with your own, frequency and activity level. and your personality to some extent. Know thyself is always kind of the most important part to any rule setting. But again, and by the way, that rebalancing point actually goes back to the earlier discussion, which is how do you prevent yourself from growing overconfident? With a rules-based approach that goes back to target that forces you to sell the thing which you're most excited about.
Taking some of that emotion and that I think you and I spoke about last time the religion in your investment when you're have too much faith it's or have too much conviction in it, it's time to lose faith, right?
Right. And that was partially kind of talking a little bit to the Bitcoin community, because people, I think, are so extreme in their views. Again, I don't understand why it has to be all or none. And it has nothing to do with intelligence level. It just has to do with logic and psychology. Bitcoin does not fix human behavior, period. Nothing does. Okay. Even algorithms are based on human behavior. They're just trying to exploit it. Right. So, and then there's behavior on the algorithms, right? So you can't ever you can't arbitrage human behavior, period. So yeah, that line, right? It's like when investment becomes religion, it's time to lose faith. It's just my way of saying don't have conviction, which is a very counter investment idea. I say don't have conviction because nobody can predict the future, right? And that's kind of the perverse thing about concentration risk. To get very wealthy, you have to take concentration risk. Right? You have to take a concentrated bet if you're trying to get wealthy, but that's also how you try to get poor. It works both ways, right? If you're trying to simply preserve, protect, grow over prolonged periods of time, you can't have conviction, which is exactly what diversification is.
Absolutely. And I like on your avatar on Twitter, instead of laser eyes, you have golden lumber, right?
Yeah. It's well, some people seem to think it looks like corn on the cobs when they look at my Twitter account. That's just me kind of trying to have fun with it. Listen, Twitter for me is a great avenue to kind of get the word out, get the name out. I try to also entertain myself, which is why I put these tweets out. And I hope at least those that are listening and that track my stuff, they recognize that, I take this work very seriously. I'm not just somebody that's saying this stuff. My crystal ball is no better than everybody else's. No amount of intelligence, no amount of knowledge increases the clarity of one's crystal ball. Which sounds kind of strange because then why did everybody just listen to the last 30, 40 minutes of this conversation? Because I think humility and recognizing that you have to be able to know what historically has worked is everything. I went on this whole rant about how it's like, you see on the financial media, all these people talking about all these investments and these relationships. 99% of these people that are interviewed in traditional financial media, they've never done a single back test. How can you possibly have any faith that what they're saying outside of their own conviction in themselves has any validity if they haven't actually empirically tested this stuff based on historical data? And by the way, even if you historically test something doesn't mean it's going to continue, but at least have the humility to know what works and what doesn't historically. It's mind-numbing to me that this industry is so filled with people that they don't know if what they're saying actually has merit.
Mm-hmm. They don't know that they don't know, maybe.
Yeah, exactly right.
Yeah, it's I think it's a great point to really, if Twitter is not good for anything else, it's good to expose you to different ideas and to really challenge some of your, let's say, preconceived notions. Some of these relationships that we've seen work for years on end, and all of a sudden they're not working. Be able to question and look at this stuff from a different point of view, right? And that's a lot of what this show is about, is to look at different points of view and evaluate them for each their merits and where they fall short.
Yeah, and I think you have to be careful. I always say on Twitter, it's echo chambers are not welcome here. Like, I'm going to go out of my way and retweet things that I actually disagree with, just because I think you have to have some different ways of viewing things. Otherwise, you get too blindsided in your approach. Mm-hmm. And keep in mind, it's okay to be wrong. Right. This is the thing about this. We live in the small sample. We live in the sample size of 1, the n equals 1. Mm-hmm. But if you're going to follow any strategy, you've got to roll the die more than once. Most people don't realize that. That's why this is so challenging, this business, because the small sample can define a long period of time, even if that's outside of what the probabilities would suggest over long cycles. Right. Mm-hmm. And short-termism obviously doesn't help with that. But again, I would encourage everybody that's consuming content and trying to, and God bless you, Tom, for everything that you're doing with this program and everything you've done with getting different voices. Listen to as many differing opinions as possible. recognize they are opinions, and then empirically test, and then make a decision based on that.
Mm-hmm. Yeah, that's absolutely excellent advice, Michael. Do you have anything else you'd like to touch on before we wrap up here?
Yeah. So, I mean, the only thing I'll say is I do, as I've mentioned, I think there are these two, let's call them gray swans, not quite black swans, right? Real quick. And I've been addressing this at leadlagreport.com, but one is the Delta variant, and it's not so much about the health impact of the Delta variant, but policy changes because of it. I think that might spook the market. And then the other one, which I've been referencing, which I could be totally wrong on, but I think it's worth thinking through, is what if S&P and Moody's enter the conversation and they downgrade U.S. debt just like they did in 2011, given the trajectory of debt, this infrastructure bill that's coming, all the other stuff that we've seen with leverage increasing since COVID. Unless they've internally said to themselves, it's modern monetary theory, debt doesn't matter, in which case they should remove the credit quality rating for the U.S. government to begin with. I kind of feel like they have a fiduciary responsibility to at least address the outlook for U.S. debt. Just like in 2011, when S&P downgraded U.S. debt from AAA to AA+, it seems plausible that the conditions are there for that to happen again. If I'm right that that happens, the last time you had a downgrade of U.S. debt by S&P and by Moody's in 2011, 30-year yields dropped 50 basis points in 3 weeks. The S&P 500 dropped 17% in 3 weeks. You can give back the entire gains because of how much leverage there is and the sudden realization that nothing matters until it matters. Mm-hmm. And then it's the only thing that matters when it matters. It's where we've gone around circle with this conversation. And I think that's the one thing that will probably matter the most if it does happen.
Excellent point, Michael. Of course, you, like you say, you're available on Twitter at @LeadLagReport. You put out a lot of, interesting stuff and great articles there. Anywhere else you want our listeners to find you?
Yeah, no, I appreciate that. I mean, for anybody that's kind of curious, not just about the Lead Lag Report, but even how I apply these concepts, leadlagreport.com. And of course, to learn more about the funds, the RORO ETF, the JOJO, bond, junk on, junk off ETF, ATAC funds, atacfunds.com. ATAC just stands for atactical. But I do believe that in a world of zeros and ones, that it's important to take the extra step and communicate. That's why, as much as I have time in the day, as much as possible, I try to engage. And I'd rather have the right types of investors that understand what I'm doing than those that are trying to chase. Those that are trying to chase often get trampled on.
That's a really important lesson that I've learned a couple of times in the cryptocurrency market. And, sometimes it's an expensive lesson, but it's a really important lesson to not chase and to, let's say, look at your fundamentals, what should be working, and, really rely on those rules that you've set for yourself, right?
Sure. Absolutely. 100%.
Perfect. Thanks so much for your time today, Michael. Really appreciate it.
No, thank you, Tom, and great work. I'm a big fan of yours. So everybody that's watching, subscribe to Tom's channel.
Thank you very much. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.